The top business stories live from the Sky News City studio. US borrowing costs ease ahead of an expected decision from the US Federal Reserve to keep interest rates unchanged tomorrow. The government backtracks on plans to close railway station ticket offices across England. And the family locator app Life 360 unveils a host of new safety measures. I'll be speaking with its founder and chief executive. Good afternoon. This is Business Live with me, Ian King. US borrowing costs have fallen slightly ahead of tomorrow's interest rate decision by the US Federal Reserve. The yield on 10-year Treasury bonds last week hit a 16-year high of 5.021% on concern that interest rates will be held higher for longer. But they slipped today at one point to 4.803%. Well, the Fed is widely expected to keep its main policy rate, Fed funds, unchanged in its current target rate of 5.25% to 5.5%. Well, joining me now is Wei Li. She's the Chief Investment Strategist at BlackRock. Wei Li, good to see you today. We got news last night that the US government expects to borrow $76 billion less in the final 3 months of this year. Is that why yields have eased today?
Possibly, but yields have been so volatile. It's really hard to pin down specific drivers. But you're absolutely spot on that the big event for this week is actually the Treasury refunding decision, because close to $800 billion of additional issuance this quarter and similar magnitude for first quarter next year would actually put us to getting outstanding US Treasury close to $6 trillion versus $3 trillion during the debt ceiling discussion. So issuance dynamics is a big driver for yields at the moment, rather than the Fed decision, which, to your point, is widely expected to be on hold this time.
Yeah, these are mind-blowing numbers, aren't they? $6 trillion. I mean, we did get some numbers today that kind of suggested the economy is still thriving. Wages growth stronger than expected, and also house prices up for the third month in a row.
And that follows the stronger than expected Q3 GDP print recently as well. So indeed, US economy has been supported by strong consumers, as well as specifically in Q3 by inventory build. But if we think about what could happen in the coming quarters, consumers, as they run down savings buffer, they could no longer provide as much support to the economy. And also inventory build points to potential future weakness. So yes, we think that the Q3 print was stronger than expected, but the next step is for economies to normalize somewhat. So US economy is strong, but we need to view that in the context of structural supply constraint, and that's what the Fed will have to consider.
I mean, it's a very balanced decision based on what you've just laid out there. I mean, is it your contention that Fed funds have gone as high as it will do in this cycle?
Possibly. For this week, certainly on hold, but maybe in December there is one more hike, but we think no, but it's closer than the kind of the calculus for this particular decision. But what is more important is how long they will stay at this elevated level. So if you look at market pricing, we're looking at around 100 basis points of rate cuts for the subsequent 3 years after peak rate, which is a lot more muted versus historical kind of cycle rate cuts. And this points to this environment of new regime, more persistent inflationary pressure. Today's employment cost index continuing to support that, but also pointing to this environment that central banks will have to hold tight in this new environment, which is very, very different from previous cycle.
It really is. I mean, not a lot of market participants have worked through these kind of conditions.
Well, the last time we had this type of notable regime change, we're talking about 40 years ago. So very few of us were actually working in markets back then, which is even more important now in terms of adjusting to this new regime, higher rates, what that means for asset allocation. So in our framing, markets are starting to reflect the new regime, thinking about higher rates. Risk assets are also starting to reflect some of the characteristics of the new regime, thinking about the correction in US equity markets 10% recently. So risk assets are starting to reflect. And when we get to the point where we can say new regime is in the price, and I think that's where we can see greater opportunity. Right now, we're very selective. We see opportunities in duration, in the UK, in the US less, but we have recently upgraded our US long duration underweight to neutral. We also see greater opportunities on sector themes based on earnings momentum, and here tech as a theme we continue to like.
Yeah, there was something I noticed in your latest note there. You were pointing out that US corporates are less dependent on bank lending than once they were. Does that have implications for the effectiveness of the Fed raising interest rates and the transmission mechanisms?
It's all related. So what has happened, thinking about the higher rate environment, is that it's really accelerating kind of the transition in terms of the role that banks play as well as other credit providers play in terms of funding the US corporates. SVB episode earlier in the year further accelerated that transition. So what we're seeing is that actually in terms of source of lending, it's becoming more diverse as banks withdraw from providing credit, given the economic calculus becomes less attractive for them. Private credit is stepping up. And as we think about lower leverage associated, that could be better for the ecosystem, and higher rate is better for savers as well. So more broadly, this is a good kind of direction of travel, but there is no denying the fact that actually the cost of credit is going higher.
OK, we have to leave it there. Good to see you again this afternoon. Thank you.
Thanks for having me.
Some other business news stories for you now. And Odey Asset Management is to be wound down 5 months after allegations of sexual misconduct were made against its founder, Crispin Odey. Well, Mr Odey denies all of the allegations, which were first published by the Financial Times in June. At its peak, Odey had £13.3 billion worth of assets under management. Its closure comes despite Mr Odey being ousted not long after the allegations were made. The drugs giant GSK said this afternoon it will pay around $1 billion for exclusive rights to further develop and commercialise Johnson & Johnson's hepatitis B therapy. The treatment, called JNJ-3989, is an antiviral treatment targeted at the liver to treat chronic hepatitis B, which affects an estimated 300 million people annually. GSK said exclusive rights to the therapy would support and fuel the expansion of its own hepatitis B treatment, Bepirovirsen, which is currently in late-stage development. And shares of BP have fallen by more than 4% today after the oil and gas major reported lower than expected profits for the 3 months to the end of September. Well, BP's underlying replacement cost profit, which is the industry's unpreferred measure for the quarter, came in at $3.3 billion. That was up from the $2.6 billion achieved in the 3 months to the end of June, but it was short of the $4 billion that the market had expected. BP also said it had booked a $540 million impairment charge against its 3 wind farms off the coast of New York after failing to win permission from the US government to renegotiate power purchase agreements to reflect inflationary pressures. The results are, of course, the first to be reported since Bernard Looney stepped down as BP's chief executive on the 12th of September after failing to disclose to the board his past personal relationships with colleagues. Now, the government has dropped plans to close railway station ticket offices across England. The U-turn comes after 2 passenger watchdogs, Transport Focus and London Travel Watch, launched formal objections to the planned closures. The industry had proposed the closures in order to cut costs, amid evidence that just 12% of all rail fares are now bought from ticket offices. I've been speaking to Robert Nisbet from the Rail Delivery Group, which represents the train and freight operators and Network Rail. I asked him how much money the closures would have saved.
This wasn't one gigantic consultation process. It was hundreds of different consultation processes that were effectively set up to configure each one of the stations, because not all stations are created equal. So all of them went through the consultation process, and we invited, obviously, people to come in with their responses, which they did in many, many numbers, and we're grateful for the responses that we received.
But now that these proposals are off the table, presumably the government is still urging the industry to save money. Does this mean that cuts are going to have to be made elsewhere?
Well, what we have to do now is go back and look at what the next step is, because the financial reality remains the same, and it's a very difficult one. There is more taxpayer money going into the industry than there is ticket revenue. That remains the same. And the fundamental core principle the rail industry still stands by, despite today's decision, and that is by shifting people out from behind the ticket office window onto platforms and onto station concourses, where they can deliver more help to passengers, especially with those with accessibility needs, actually is a better use of resources, because just keeping those ticket offices open does cost a lot of money per year, and that is one way we could make a saving. But there are other ways, of course, that we can look at how the industry operates. You see the rollout of tap in, tap out across London and the southeast, known as Operation Oval within the rail industry. That has been a huge success. So we have to look at different methods now to be able to get the rail finances back on a sustainable footing.
Is there anything to stop the industry from charging more for tickets bought through a ticket office, so that, for example, those who are benefiting from this decision, and as you say, it's only 1 in 8 rail passengers now, are actually paying for it?
Well, that will be a decision for government. As you know, Ian, the rail economy, the finances of the railway have changed considerably since the pandemic. And the franchise operation, where operators took the revenue risk, no longer exists. The train operators are operating under effectively concession contracts. So it is the government that sets the direction, and it's the rail companies that operate kind of within that. I think what is important to point out, though, is the fact that this was a genuine consultation process. And that the industry moved considerably in a number of different directions to try to satisfy the concerns, the legitimate concerns raised by passenger groups and accessibility groups. So we moved, for example, on saying that in the majority of cases, the staffing levels at stations today would remain after the changes had happened. Vending machines would be upgraded, and also there would be welcome points rolled out across the network, because it's important to remember that half of the stations in Great Britain don't have ticket offices anyway. So this is a model that's already in operation. We just wanted to extend it across the country.
What's the situation like in comparable economies such as France and Germany? Do they still have masses of these ticket offices that go unused for great parts of the time?
No, you will see that there is similar operations, similar discussions going on across Europe. Sweden, for example, has already made the move, but you don't actually have to look abroad. You just have to look at Transport for London. They got rid of their ticket offices on the underground system back in 2015, and that went particularly well. Satisfaction rates have been climbing since they did that. So this is not without precedent. And as I say, the industry stands behind the core principle, and Transport Focus backed that core principle today, in that redeploying staff to where they're actually needed to deliver more help to passengers, especially with accessibility needs, is the direction that the industry should be going.
Now, the family locator app Life360 has unveiled a range of new safety features, including crash detection, which can sense collisions over 25 miles per hour and send notifications to family members and emergency services. Well, Life360 was founded in 2005 by Chris Hulls, who was inspired after seeing families displaced by Hurricane Katrina. It now has 50 million users worldwide. And joining me now, very pleased to say, is the founder and chief executive of Life360, Chris Hulls. Chris, welcome to you. You've already introduced these enhancements in the United States and Canada. What's take-up been like there?
Take-up has been great. We're now one of the top 15 apps in the country in terms of how many active users we have. And we've shown, as digitally native families have become the norm, people are looking to their phones to get through the day. And people are fundamentally always wanting to make sure the people they care about are safe. So we are growing very rapidly, over 50 million active users, expanding to the UK with a much broader feature set, and very, very fast take-up.
You have some 3.7 million members here in the UK. What proportion of them need to take up these enhancements for it to be a profitable service for you?
We already are doing quite well from a profitability standpoint in the UK. We are very confident, though, based on what we've seen in the US, that this can get us to that next level where we can be just the fabric of families in the United Kingdom in the same way we are in the US. We are already at 1 in 11 families in the UK using the product. And we think there's a real chance we can get to 1 in 5 because we already are seeing many states in the US where we're getting 20, 25% penetration rates.
What have you learned from the rollout in the US and Canada?
What we have learned is that people think that location sharing is about knowing where someone is. And when people use it, though, this actually becomes a pulse of your day. Someone gets to school, someone has a low battery, you're thinking about someone, you're caring about someone. It's not just where are you, it's how are you. And in the same way that Facebook built the social network for your friends, location really is an underpinning for the family. So we think that we have a real shot, and we already are that digital equivalent of where your family goes to stay connected.
Who will be providing the roadside assistance services for you in the UK?
We have a number of vendors. We have our own brand behind this, and then we piece together different vendors. Obviously, we're not going to have our own tow trucks, but it will be Life360 providing that service.
And more broadly there, you touched on subscriptions levels in the UK and elsewhere. I mean, what are the drivers right now? Presumably things like back to school are a very big event for you.
So back to school is when kids get new phones, new responsibilities, and we really are aging into our primary demographic now. We've been around a very long time for a mobile app company, but it's now that millennials are having kids that are getting smartphones, that's what's really driven our growth in recent years. And people are realizing this is truly life-saving. We've sent out over 40,000 ambulances in the last year, and every few days we get a story about a kid who was in an accident, knocked unconscious, and it was only because of Life360 that their life was saved. And those stories really have power and meaning. And in the United States, it's almost been this thing where if you don't get Life360, you're not being a responsible parent. And we're not trying to be fear-based with that. It's more, why would you not do something that you can start using for free, very inexpensive for the premium service, if it truly can save your kid's life, and just make your day easier by not having to say, where are you? How far away are you? Call me when you get to school. These things are all done completely automatically with Life360.
One thing that I pick up from time to time, my wife has complained about this, is that the app can be quite draining on mobile phone batteries.
That is actually not the case. Oftentimes people will have a bug and they just assume it's the app that's doing it because our location's on all the time. We are very rigorous about testing. For the average person who drives 90 minutes or less a day, we will usually be 3% of your total battery drain and almost never over 5%. So we encourage people, go to settings, go to the battery meter. People are actually surprised. We are usually almost always not the culprit of battery drain. The tech has gotten so much better over recent years. I can get a little bit nerdy, but the accelerometer, which is the sensor we use to detect all the driving behavior from crashes to phone usage, it's now on the chip. So the battery drain is actually quite low, and screens that have gotten bigger and bigger, that is the number one thing that does drain a battery.
Well, that's good to hear. Thanks for making that clear. Chris, lovely to talk to you this afternoon. It's much appreciated. Thank you.
Thanks for having me.
Now, European stocks have finished the month on a high note, but all of the main continental European indices have notched up losses for October as a whole. As you can see, the IBEX in Madrid finished more or less unchanged. Big gains elsewhere in Europe, but as I say, all the main indices lower for October as a whole. Among talking points this afternoon, Casino, the French grocery retailer, finished up 5% in Paris following its latest trading update. Well, here in London, the FTSE 100 finished slightly in negative territory. And again, it's finished October lower. FTSE's fallen by some 3.75% across the month as a whole. And that makes it the worst monthly performance since June of this year. Weighing on the index, I think the FTSE would have probably finished higher were it not for BP, which finished 4.5% lower on its results. That was enough to clip 15 points from the index on its own. Shell came down in sympathy, and that knocked another 12 points off the FTSE. So if you strip those two out of the equation, the FTSE would have finished higher on the session. Elsewhere, Vodafone also fell off 1.25% roughly. That's after it announced plans to sell its Spanish-based arm to London-listed Zegona Communications for €5 billion. Among the gainers, there were some. Rolls-Royce finished up more than 6.5% higher. That was after it received a push from one of the brokers. All of the house builders are also higher, and that was after weaker food price inflation raised hopes that the Bank of England may not raise interest rates again shortly. Outside the FTSE, The precision engineering group Spectris finished up by 3%. That was on the back of a trading update. On Wall Street, meanwhile, all of the main indices are lower following some disappointing trading updates. Those reporting this afternoon include Caterpillar, which, as you can see, is down by more than 5.5%. That is on concerns over a drop in its order backlog. Meanwhile, Nvidia, one of the star performers on Wall Street this year, it's currently down by some 2.75%. That is on concerns over falling orders from China for its AI chips. On the foreign exchange markets, well, the big story of the day by far has been the Japanese yen, which fell to its lowest level against the US dollar for more than a year. That was after the Bank of Japan made a move away from its ultra-loose monetary policy, but less aggressively than expected. Sterling, meanwhile, has finished it's currently a quarter of 1% lower against the US dollar. It's up by 1/6 of 1% against the euro. The single currency, meanwhile, off nearly 0.5 of 1% against the greenback. The oil price, you can see it on the screen there, it's rallied after yesterday's big sell-off, but it remains well below $90 a barrel. Brent crude currently changing hands at $87.62 a barrel. That's up a little under 1/5 of 1%. Well, joining me this afternoon is Kartik Kumar, UK and European Equity Manager at Artemis. Kartik, good to see you today. This Bank of Japan move, I mean, it's far removed from the European and UK equities markets, but it is nonetheless a big, important development today.
Yes, it's striking for a couple of reasons. So firstly, Japan has about $8 trillion of debt outstanding. And if you think about that, that's about 2.5 times the level that the UK does. And so any potential change in the long-term borrowing costs of Japan have the potential to have reverberations around the world. And the yen, as you touched on, I mean, a 1% fall for a currency is actually quite a big move. And if you look since 2021, the yen's lost about 1/3 of its value against the dollar. So it's really quite a striking move in the currency.
Yeah, I think it's off to a 17-month low against the euro as well. I mean, presumably the BOJ is quite happy to see the yen falling like this, is it?
Well, actually, the yen's at levels at which the BOJ has intervened before, so about 150 yen to the dollar. And I think what you're seeing is the markets are increasingly saying that there's an inconsistency between economic fundamentals in Japan and monetary policy. So inflation in Japan is 3%. The Bank of Japan actually raised their forecast for next year quite meaningfully by 1% from 2% to 3%. And so that inflation experience is actually not dissimilar to what you're seeing elsewhere in the world. And yet, short-term rates in Japan are negative. They're minus 0.1%, and long-term rates in Japan, and this is really where the policy change came, which I think the market sort of regards as a baby step when they were expecting something more, is still capped at 1%. And so that's why you're seeing this pain being manifested in the currency.
Now, big week for central banks. We've already had the BOJ, we've got the Fed tomorrow, and of course the Bank of England on Thursday. We had some insolvency numbers today which were quite troubling. Do you think that will sway the MPC either way?
Well, I think that's part of the sort of broader debate, which is an interesting one, which is central banks today are saying that they're data dependent. Whereas if you look historically, and I sort of remember this from my Target 2.0 training in GCSE, monetary policy doesn't impact the economy without lag. And so if you look today, forward-looking indicators would actually suggest that inflation is falling quite sharply. Even current indicators like the Eurozone today. And yet, because of the high level of core inflation, so it's 4% in Europe, central bankers seem reluctant to act. And that sort of raises the question as to whether the sort of driving whilst watching the rear-view mirror and whether the current rates, which are really quite restrictive, might need to be eased more quickly than expected.
Yeah, there's a lot of data out there now which is quite disconcerting. I mean, not just these insolvency numbers, but some of the figures around the labour market suggest there's softening going on there.
Yes, the labour market is cooling. Vacancy levels are coming down. If you look at, say, if we talk about the UK, UK migration numbers in 2022 were at a record high. So these idiosyncratic factors that we use to say explain why the UK might have a sort of inflation problem of its own look to be cooling.
And we get the nationwide house price numbers, of course, tomorrow. Would you expect to see further cooling there as well?
Well, that's an interesting one because housing is a subject that's close to the hearts of all Brits, and also because it's one of the most interest rate sensitive areas of the economy. And I think it'll be interesting to see tomorrow because house prices have proved to be more resilient than expected. And if you look at that, I think I'd make two observations. Firstly, a 6% decline in nominal terms actually masks what is an even worse than that decline in real terms. So inflation-adjusted terms, you've had a decline of over 10%, which is coming to the levels at which you've seen historic house price declines. But the second point, which I think is interesting, is you see it in all the statistics that the UK housing market is undersupplied, and you're seeing that strength in demand coming through in rental inflation, which is up 10% across the country and 12% in London. And so if you take a step back and think about it, compared to a year ago, house prices down 6, rents up 10, 12. From purely a financial perspective, housing is actually a much more attractive investment than it was a year ago, and perhaps that's explaining some of the resilience you're seeing in the data.
Some interesting points there. I mean, before I let you go, it's been a pretty miserable month for UK equities. We normally get a rally in November. Are you expecting one this time around?
I don't know. I mean, it's impossible to predict where asset prices go in the short term. I guess historically, seasonal data would suggest you get some sort of Santa Claus rally. And in my opinion, given how weak prices are, you might provide more confidence in that happening than otherwise.
Yeah, you might. Are you finding many bargains in the UK market right now?
Yes, a lot. I mean, if you look across the market, there's a sort of a cloud of malaise and negativity, which means that cheap assets are quite often just getting cheaper.
Yeah, good point. Kartik, lovely to see you this afternoon. Thanks for joining me.
Thank you.
That's it from me. I'm back again with Business Live tomorrow morning at 11:30. Hope very much to see you then. Thanks for watching this afternoon. Cheerio. That was great. Don't go away.